Good day, everyone, and welcome to the annual results of Ascendis Health for the year ended 30 June 2023. I will start off by explaining a little bit of the background on how we found ourselves where we are today. Need to start by thanking the team that has worked tirelessly behind the closed doors in trying to salvage as much value for the shareholders as possible. We have a immensely loyal and committed team, and without them we wouldn't be sitting here today. I will try and keep it brief, as currently we have zero institutional support for Ascendis Health on the JSE. Unfortunately, there are also no prospects of any change in this, and thanks to a support of a handful of shareholders, the share price has been supported. Whether we like to admit it or not, I think Ascendis Health is not an asset that is largely followed by the investment community. We've gone through a year of consolidation. We will rehash one or two things that's happened in the first 6 months. The successful rights issue, where we raised 101 million rand. We sold pharma. We were able to increase the incremental sales value by an additional 57 million rand. Then, subsequent to the previous 6 months, we've actually repaid the entire group debt. That was a excessive burden to the group at very high interest rates. We have been able to successfully put in place additional banking facilities with RMB of a GBF of 50 million and credit card and other facilities that makes up a total of 82 million rand. I think that is, it says a lot. Previously, this business was effectively unbankable. The team has also mitigated significant onerous tax, legal and rental obligations during this process of stabilizing the balance sheet. And then we've moved into a area where we've tried to optimize operations. Part of the mitigation processes for the tax and rental obligations was an environment where we strategically were forced to put surgical innovations into business rescue. That process is substantially implemented. It has been approved, and hopefully by the time the audience listens to this presentation, we would be successfully out of business rescue. During this process, we would have salvaged a lot of value for the group. We've successfully closed down the Ascendis supply chain that has resulted in an annual cash saving on previous losses of up to 60 million rand a year. All of these numbers, I think, do need to be taken into account when you consider this against the market cap of the group of just north of 400 million. Any of these situations, had we not had the significant intervention of the team, could have been the downfall of Ascendis. There's been a substantial wind down of the group head office from 95.5 million rand to 35. I think it's important to note the 95.5 does not include any of the advisory and transactional costs that the previous management teams incurred. During this process, in the past, management had an outsourced model where, despite significant salary overhead costs, a large portion of the functions were actually outsourced as well. And in reality, the 95.5 was probably closer to 140 million rand. Then moving on to the financial performance overview. This is self-explanatory. Obviously, we've reduced the debt. It's gone down to zero. Revenues remain stable. On the top right, it is still unfortunate that we've had to incur additional impairments on property, plant and equipment and some intangible assets of close to 130 million rand in the past year. That's largely been fixing the mistakes of the past and applying more prudence to how we assess the value of the group. I do believe, and I'm hopeful, that impairments will not persist in the future. The adjusted operating loss of 92 million rand is still a work in progress. Then tangible net asset value of 81 cents per share. I do believe there is some value in this group, but it will take some time. We have another year or two before we can actually see the true value unlock of this group. It is also important to understand that 81 cents does not include the cost drag of the current head office of 35 million rand per year, which is the bottom right slide. Then update on key initiatives. We've mentioned some of this already. We have committed funding of 35 million rand for the post-commencement financing for surgical innovations to fund the business rescue process. As we exit out of business rescue, we are hopeful that we will be able to recoup a portion of the 35 million rand in the coming months and years. The plan was approved previously, and post-implementation, we would have seen a saving of 70 million rand on total claims and liabilities. The primary saving there was a claim from SARS, which we believe was not necessarily legitimate, and it is worth noting that the actions and the frustrations that we experienced with SARS is not something that I feel is conciliatory in this current economic environment of South Africa. We've had very positive and successful engagements with the landlord, who I believe has now become a business partner of this group. We have managed to renegotiate a lease that is more palatable and market related. That's resulted in a cost saving of 12 million rand per year, aggregated over the term of the lease. That gets close to a 70 million rand saving for this group. There's been a significant organizational restructuring, and we've been able to do this, and the team's been able to do this without any significant disruption to trading. We've closed down supply chain. That entire process was entirely self-funded. I would like to thank the team at Ascendis Consumer Brands for the heavy lifting that they did there. Without them, that would not have been possible. And as mentioned, we've saved now approximately 5 million rand a month of cash losses. During this entire process, against all odds, we've actually been able to improve Ascendis Consumer Brands margins by shifting the bulk of our production to Vital Health, which has now become a key and primary business partner of this group. Moving on to the income statement, revenues remained largely flat, slightly down. Gross profit is also slightly down. The EBITDA loss has improved or decreased by 70%, while the operating loss has improved or decreased by just short of 30%. It is worth mentioning that the numbers here include 11 months of surgical innovations prior to it going into a business rescue, and I think the surgical innovations that will be out of business rescue will show a material improvement in the numbers. If we then move on to the income statement and what it's made up of, I think I only want to highlight one or two things here. Total impairments, which is the third block, of 132 million rand. Transaction costs that were incurred by the previous regime of 35 million rand in the first 6 months of the year. And then the SARS VAT dispute of 53 million rand, which are three big ticket items that is not to be repeated in the future. And then depreciation and amortization is a big ticket item where we have applied a more prudent depreciation and amortization accounting life cycle. Moving on to the key disclosures, I think it's clear here that there has been improvement, but we're not out of the woods yet. We show a basic profit per share now of 12.4 million rand. Which includes profits on the sale of the pharma business. Headline loss is still a challenge at a negative 40 million rand, but it shows a 51% improvement. Moving on to the balance sheet, If you move right down to the bottom, you can see that the net asset value or the equity value of this group has improved by 160 million rand. The two big moving items there will be on the next slide, but it is effectively the rights issue that we use to stabilize the business, as well as the sale of pharma at a significant profit. But the operational and transactional losses incurred through the excessive head office cost and outsourced model of this group then unfortunately had a negative impact on that. The small positive there is that those costs and that run rate is not to be repeated in the future. At the top line, PPE, you can see that it has decreased substantially from 231 to 120 million rand. Trade and other receivables has also decreased, but coincidingly, trade and other payables has decreased from 424 million rand to 314. If we move on to the next slide, this highlights where we are. Opening equity of 402. We had a comprehensive income and rights issue, which is about 160 million rand. But then we also had some smaller adjustments on deferred tax and intangibles, making up the 81 cents per share. Would like to repeat that although there's a significant improvement from the tangible net asset value of 62 cents to 81 cents, the 81 cents does not include any cash drag or cost drag from a head office cost. So if we had to apply a sum of the parts principle, the 81 cents would probably go down, but coincidingly, none of the assets have been revalued to fair market. Some of them might have write-offs, but we do believe that in the coming years, these underlying assets have a lot of potential. Moving briefly onto medical devices, the segment. Some of this is not for happy reading. We've increased our revenue by 7.1%. That increase is slightly misleading. I believe that if you look at the improvements in sales at Ortho, the newly carved out Cardiotech and Intervimed businesses, where our growth has been in excess of 20% over the past year, the change should be like for like significantly higher. I think the decrease has been where we have unfortunately lost one or two very small agencies, but we've also decided to stop doing business that is not economically viable. So that there has been a rationalization that skews the numbers slightly. I think the normalized EBITDA that's gone down from 45 to 2 million rand. Some of that will correct significantly in the coming year, but also a big portion of that has been the South African rand declining against the dollar and euro. Moving on to consumer health. We've had a very tough year where the change of 16.8% is something that has been a very challenging situation to manage. It is positive to see that the corrections and the interventions are now starting to bear fruit. And as we stand, I think for the first time since our introduction into the management teams of the different portfolio companies, we are not only meeting budget, we are actually above budget, and we are confident that we have a good chance of achieving the results of the past in the coming year. So there is some green shoots based on all the interventions of the past. Compounding pharmacy is doing quite well. It's generating significant cash. Kempia is a highly cash generative business, and Ascendis Consumer Brands, there has been a significant restructure with the closing down of supply chain, which had a significant drag on this business. So all in all, I think consumer health is in a healthier state than the numbers would show currently. Again, it will take 12 to 24 months for us to unlock the true value here. It is also worth mentioning that given the process that could unfold of a potential delisting, post delisting, it is anticipated that certain assets that we do not see significant growth in are likely to be sold. That is any of the underlying portfolio companies, whether it is in the medical devices sector and or the consumer health sector, assets that we can realize significant value for shareholders, we will sell and dispose of and distribute the capital back to shareholders. Moving on to head office, we've spoken about this at length already. Head office costs are down significantly. Once-off costs are down significantly, and the 35 million rand once-off costs that incurred in this year, I believe it'll be halved again at least in the coming 12 months. There is a case for the head office to rationalize further. Unfortunately, that will not happen during a JSE listed environment. Moving on to a delisting, I think it is critical to understand that there is value to unlock for shareholders in this group, but the value will not firstly be unlocked during a JSE listed environment. We have no institutional support for the share at the moment. It is a micro cap, and the quickest and easiest path for value unlock for shareholders that want to stay the course would be to support a delisting as an enabler for the stakeholders to extract value from this group. The JSE has high direct and indirect listing related costs. They have processes in place that are key to large caps, but are frustrating for the timelines associated with implementation of transactions, which limits our flexibility and our agility. So as a key walkaway from this presentation, I think it is critical for the path that the board has agreed on that a delisting is aggressively pursued. The journey ahead, we have effectively concluded the stabilization, in our opinion. There is an active process of optimization and growth. I think it is important to note that none of the businesses are in a state that they are easily sellable just yet, but it's a work in progress, and we are very confident that we will get there in the coming year or two. Eventually, the return of capital is something that will happen. It is a board directive that we have received. It is furthermore also clear from our current shareholders that it is a key requirement for our shareholders to receive some capital back for all the shareholders that have supported us so loyally in the past years. I don't think in the Ascendis world shareholders have been given the respect they deserved or received the thanks that they deserved for supporting this company in a very, very chaotic and tumultuous period. So I would like to take the time to pause and thank our current shareholders for the support they have given us until now, and encourage the shareholders to support a delisting and stay the course for an eventual value unlock of this group. That is the end of the results presentation. As always, if you have any questions, please do reach out to investor relations or even myself. Although my time is often limited, I will endeavor to reach out and return any questions directly within reason. My door is open and we are able and willing to engage with all our stakeholders. Thank you very much.